All right, so the markets continue to be kind of in this summer swoon, like not necessarily a swoon, but a summer grind. So it's really not going up or down, and we're, again, like Monday's video, kind of on this cusp of breakout, but not quite there. A lot closer on the Russell 2000 this week than we are in others. So we're going to take a look at how things have changed today versus Monday to see whether or not we have had enough now to consider it a breakout and more bullishness to come, or whether or not we are at some resistance and how likely that resistance is to hold. Are there some technical signs that support the resistance in this area? So that's what we're going to break down in today's video. We're going to take a look at stock that kind of trade allows us to take advantage of this not really bullish but not really bearish theme either, but still allow some room for both on this particular trade idea, if that's where the case, at least in this case, going into July. So let's go ahead and get started. Today is Wednesday, June the 9th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see you ended up with a little bit of a down day, but not much of a down day. I mean, down 0.2%. It's not very much of a big deal. In fact, if you take a look at this daily price move, again, I mean, look, we're just not getting any kind of moves above or below 0.5%. Look at, we've only got out of the last, how many days? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days. We've only had 2 days exceed 0.5% gain or loss, and they happen to both exceed 1% gains, or close to 1%. This one was 0.9%. That one was 1. That one did get a little bit over 1. But for the most part, we're between 0.5% and negative 0.5%. So we're really grinding here with volatility low, implied volatility low, and historical volatility having had ramped up a bit during this little period of weakness in May, little tiny period of weakness in May, ramping up volatility, but you can see potentially grinding back down again. I mean, even during this decline here, you can see during this decline where historical volatility dropped down from a peak during what was an intermediate pullback for the NASDAQ till now, that decline. You look at this, we had plenty of days up and down where we exceeded 0.5% gain or loss. So far, we're not getting anything. It's almost a very similar stretch to what we had about right there in February. Going into the end of February, you see we had a stretch of a bunch of days there. Let's see where they're at now. They're over here. So where'd they go? Right there. So yeah, these days, so about 1, 2, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. In 14 days, we only had 1, 2, 3 of them that were above or below 0.5% gain or loss. Give me 1 second here. So, of course, we know what happened there. If you take a look at the S&P 500 during that end of February period. So here's that end of February period where we were just kind of over here. We were just kind of grinding. Was it the end of February? Where was that? Let's go back to here. It was beginning of February. It was the beginning of February going into the end of February. So this is what it looked like on the market forecast, right? The beginning of February right here, just grinding into February expiration, and then we got that period of volatility. Let me show you what it looked like on the NASDAQ, right? That's what it's grinding into February expiration, and that's what happened. So, we're getting similar periods to what's going on right now. Very grinding. Now we got a cluster there, and we came really close to a cluster really here. In fact, I talked about this in my trading in our class today. We talked about this concept of long upper shadow, of the behaviors of how long upper shadows, of how stocks can trade in the range of a long upper shadow. but still use the peak of the top of the long upper shadow for resistance. Well, that's kind of, if you look at this kind of like one big candle here, and then the pullback there, the beginning of the candle occurring over here, and then the end of the candle occurring right there, then that would be the body. You'd have the body from open to close right there, and then this would be the shadow with all that trading, lots of trading up, and then boom, down, and then close. I mean, that would be the long upper shadow. And then you can see how we're kind of trading within the range of this long upper shadow, but obviously a lot more grinding than we had previously the first go around, and using the peak, which happened to be about as close to an overbought cluster as we've gotten this entire intermediate run, right? We got this overbought cluster in February, and that also was the peak, right? If you notice for the NASDAQ 100, that was that peak right there, the 12th of February. We got the cluster, we got really close to a cluster here. We did get it on the S&P, and that was the peak there. And as of right now, this little area where we came about as close to an intermediate of an overbought cluster as we can get, looks like it may be the peak, depending upon whether we can break through that resistance here by the end of the week or early next week or not. Of course, we always expect resistance to hold until it doesn't. So that's kind of the idea going on there. If you take a look at the S&P, again, strong intermediate posture, near-term line looking like it may be a very short-lived near-term run, as it's already crossed below 60. The NASDAQ 100, also the near-term line is crossed below 60. Its intermediate line still unable to get above the market sentiment line, so not really the most bullish pattern there either. And then the Russell 2000, its intermediate posture is strongly bullish. Its near-term line is mature. This is actually a bullish intermediate confirmation signal, an oversold momentum line with an strong bullish posture. So we'll see if that plays out to a bullish bounce as it's trying to flirt with getting to new highs that we haven't seen in a long time on the Russell 2000. We just barely crossed above 80 here after having its own about as weak of an intermediate posture as we could have, because it made it barely dip below the 23% retracement level. But it did have some dark pink shading and red lines, and intermediate line did get below 40, but about as weak of a bearish posture as you could possibly get. The other nice thing about the Russell 2000 is we were kind of showing some signs of breakout, right? We had gotten above 30 on the positive index, just barely, but we weren't below 20. We did get below 20 today, but now the positive index isn't above 30. So kind of flirting with the idea of a breakout pattern here. You can see the S&P flirting with that upper quartile of the band, but not quite. This is the bullish zone, right? Getting in this zone is really bullish, and we're not in that zone. We've been flirting with it. See how strongly bullish that can be. We're kind of in this. Again, that February peak, we actually were in the upper quartile before we hit that period of volatility. Not the case this go around. So much, not nearly as strongly bullish, and we've talked about that gap and resistance volume down there. You can see the S&P 500 or the Russell 2000 very similar. Again, the top of that peak, the third quartile with the upper quartile just barely flirting, and we're just barely above the 75th percentile as it is, and we're unable to break out of that value area. And until you do break out of that value area, then the volume node, the point of control, is going to be acting as a pretty significant center of gravity. In this case, pulling it back down, not significantly down, of course, but until you can break out, and it's kind of like an atmosphere. Until you can break out and break the hold of gravity, you can really get going. But right now, it's trying to burst, but it's not there yet, right? And we're just kind of right at the seams, as has been the case really for like the last week across the board here. We seem to be at the seams of breaking out, but not quite actually doing it yet. Before you look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also a subscribe button down below the video if you're watching us on YouTube. Hit that and the bell next to it. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. Quick way to give us feedback. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch. We're not forcing you to do that. But if you do like our videos and you want to let us know, then click on that. We obviously, if you're watching us, we appreciate that, and we also appreciate all those that are clicking that button. That goes a long way. Subscribe to our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day, and join our Market Outlook Facebook group that we've created. Watching us on our website here, scroll down to the bottom of the page, you'll see our video here, but you also see the Market Outlook live video again. We always get asked, can you follow up on these trades that you do in the Market Outlooks later, so we know when to get out of them or how you get out of them. And that's what we do with this Market Outlook live video. 3:30 Eastern time today, because of other commitments I had to do it during our options inventory class, but you can be able to see those trades that we have been in, and how we manage them and when we close them in that video. You can also get to it up here under Market Outlook Live Trade Review. Also, you can see all of our classes coming up here on the right hand side as well. If you click on this trading room, all of our paid subscribers get access to all of our trading rooms and our Market Outlook Live video, among other things. Our premium subscribers get access to it for cheaper, right, for a less cost on average per month than our monthly subscribers. In addition to that, our premium subscribers get access to all these tools and resources and access to the class forums, where we can be able to post custom content for each class and be able to interact with other class participants. Come down here to the bottom, click on this heart, opens up a new tab. Also click on this thumbs up icon, opens up another new tab. Again, the more you do that, when these do come up here, it'll open up takes a minute here with the internet access I've got. But when that comes up, hit that like button right there. Also hit that like button on the Facebook. Again, the more you do that, it really helps us out, so more people actually see our content because of all the engagements, including the likes and the comments and the shares. So we do appreciate that. It also benefits you too, because Twitter and Facebook promotes content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, now let's take a look at the 3 green arrow chart. You can see the volume down here at the bottom. Here, let me make it a little easier to see. Use a log scale. We won't fit these studies. Let's see if that helps. There we go. So you can see the 3 green arrows. Look at the MACD is dropping, so we're losing some momentum, even though the MACD is still above its moving average. It's not as, you can see the momentum declining. That's what we're seeing right now in the stochastics too. So they're still above the moving average. It's still positive. We're still above the 8-day moving average, even with today's selling. But we're not really, again, diverging. We're starting to converge just slightly. So we're not like dropping like a rock here. But we're also not diverging either. Which is what, again, when the blue line's moving away from 0, you can see it's actually starting to potentially move its back. When it's moving towards 0, that's your convergence. So that's when we start to, we end the divergence, those lines moving away from each other, and now they start to move towards each other as we just flatten out. Appears to be the case here without much divergence preceding it. If you look at like the DMI and the ADX we talked about, just not really getting a directional move, especially in the S&P 500, where we're not below 20 on that negative index. And look at the RSI and the CCI, and again, we're like at the top, on the cusp, but the ceilings are holding as of right now. The 100 ceiling holding, the 60 ceiling holding. So we're still in neutral territory. We're in the top end of neutral territory, but we're still in neutral territory. So we're not in breakout mode. And if you look at the trend strength indicator here, where the key to get a good intermediate run going is to get above 65 here, which is that dotted line, and get above 2.5 here. To get above that line, get above 2, that'd be 2 actually. To get above 2 here, and we're not quite there either on either one of these. Like, we're not even above 50, we're not even above 1. We came really close right there to a breakout, really close, but again, coming off of a strong bullish move, it's kind of hard to get a new one started without an exhale, right? An exhale that at least we saw on the NASDAQ composite. You can see more of an exhale that we had there, where we had a decline to the downside and a little bit of one here. But you can see how we're lacking that move of even a weak trend starting, much less one that can lead to an intermediate run on the NASDAQ. Take a look at the, let's see, there was one more. Oh, the long-term chart. And we've talked about this, the PPI, very, very high. So very big gap between the 50 and 200-day moving averages. Now the 200-day moving average is sitting right at that 23% retracement of this big bullish move. So a noisy long-term move. Again, long-term noisy move, which would be an intermediate pullback, but a long-term noisy market sentiment run between 0 and 23% would get us down to the 200-day. So that kind of shows you just how significant, like getting to the 38% retracement would be a pretty significant drop below the 200, and that's just a typical exhale. So that's how long we've stayed up here. It's been long enough to get that 200-day moving average rising pretty rapidly here lately and flirting with that. But the other aspect too that continues to be the case is we're just not getting very significant size Hakunashi candles here, as we're still sitting right at 30, way less than 1%. At 31% obviously would be 42 points, and we're at 30 points. And when we're bullish in this, we're getting relatively good sized bodies, and that's just not the case right now. Now we're also not getting lower shadows, and we're not getting bearish candles, but we're kind of stuck in this. We're not bearish, but we're also not strongly bullish either. This again show kind of how how we're not very bearish here is here on SPY. We actually did get a new high on this 4-week chart. And there's the selling, and that was it. So that's how small today's range was compared to yesterday's range. That's how small the past 2 days ranges have been compared to the last week. And then that's how small the 2 days range has been compared to the last 4 weeks. So again, puts a little bit of context there. And remember, until you're out of that window, that center of gravity is going to have a pull down to 420, which is only a point away. So you need kind of that escape velocity to get outside of the volume band for us to really get a breakout move going. But that's kind of, you can see the pattern there. IWM as well, with the new high that it got over the past here on the past 4 weeks. Again, it's a 4-week window. Obviously, it's not the new high, all-time high, as that would be further over here. There's the all-time high. You can see how close we are, and on the 90-day basis it has exceeded that window. So we'll see if we get a little return move and then get going, and really, because remember, it's really on the cusp of a breakout type move there, and you can see that kind of confirmed here by being on the 90-day basis at least outside that window. Whereas you look at SPY, and you can see even on a 90-day basis, we're still inside of it. So it's a pretty still significant ceiling on top of it. And again, you break that 415, and there's no volume down to 390. There's such a very big, huge gap in volume here, and we're very, very top heavy that that it'd be a little dangerous for the markets if we were to break through that level. And why we could, just move down there just because of the center of gravity. At least down to that level, not necessarily am I saying we're going to break all the way down. There's 400, there's that 23% retracement would signal the beginning is an intermediate pullback. It would be down here, but you see how easy it could get even just to get to the midpoint of this 4-week range, which is that blue dotted line. The volume, obviously, you can see is tapering off considerably. We see that as well on the 3 green arrow chart. Very little volume, 47 million. The trading range, again, under 2 points. How many days in a row has that been? So we were under 3 yesterday. We were under 1.5, or at about 1.5 the day before. 4 points there, under 4 there, under 2 there. So, again, just very, very small ranges here lately. That's having an impact here. 47 million shares trading hands is way down here. 2 points is off the charts to the downside. So, the ATR is really, really low. Again, that's a good sign when we're, kind of starting a new intermediate run. Not necessarily the greatest sign when we are in a mature intermediate run, because it kind of signals the extremes in terms of lack of volatility. And we saw that too here on the volatility chart, whereas the last couple of days we've been flirting with being below 80%, ramping up here at the end of the day, but still pretty oversold. Volatility is still very, very oversold, if not extreme, but still very oversold here, and could lead to a move to the upside, which is something we addressed with our inventory trading that we talked about. To summarize, before we talk about what's driving the price action, to summarize the technical outlook, obviously we have a bullish bias and we are leaning to the upside. We're just grinding to the upside, and we're not grinding enough to get through the ceiling. We're at the ceiling, but we're lacking the momentum that pushes you through the ceiling, and that's, again, it gets tired. Bullish markets can get tired like this when we've had so much momentum. We're going on 8 months now of this intermediate run. It's starting to look a little tired, and we've seen some signs that even compared to just a few weeks ago, we're looking a little bit tired. It looks like we're filling in a long upper shadow in this case of range over the past couple of weeks, and we're hitting the top of that shadow. Now, whether it's going to hold for resistance, and that will be the bearish move that the long upper shadow eventually produces, remains to be seen. We expect resistance to hold until it doesn't, so we would expect it to hold. But if we do get that breakout, that would give us that quote-unquote escape velocity to kind of get a new leg of this really mature intermediate run to continue. That's what we'd be looking for potentially by the end of this week. That kind of breakout type move, and it very well could come with a strong opening gap. So look for good, strong opening gaps anytime over the next few days to see it, and then breaking away from there, from the open forward. That could be what we need to break out. So watch very, very closely. Otherwise, watch for any kind of significant downside gaps that would hold for a runaway to start to actually start the pullback. So either way, we can get a breakaway or a runaway gap. Obviously, upside for the former, downside for the latter. That would be gaps that would not get filled in, that we would not expect to get filled in, at least anytime soon. Because they would start the intermediate runs in either direction, at least start a new leg of this run to the upside, and then start a new intermediate run to the downside. So what do you think? Do you agree with that assessment? My expectations are resistance is going to hold, and I don't think that we're going to necessarily fall off a cliff to the downside, but I think that this resistance will hold, and we're just kind of running out of gas on this bullish run. So again, like I said, we'll see if that ends up being the case. What do you think? Do you agree with that? Do you disagree? Comment down below, especially if you disagree. What charts or indicators are you looking at that would point you in that direction, whether being either a lot more bullish than I am or a lot more bearish than I am, that you think it's going to be more than just an exhale whenever we do start to get a little volatility. Post those in the comment section below. All right, so now let's talk about what's driving the price action. As you can see, over the past 3 months, which is what this chart defaults to, over the past 3 months, this has been a very inflation trade, right? This you cannot be more inflation trade than this. When I say that, what I'm talking about is that real estate and commodities, DBC, the orange line, and then gold, the red line, are all up here with the Qs, all up here at the top. At the bottom is the dollar and bonds. I mean, that is about as inflationary of a trade as you can possibly get. And so, and that's been continuing to be the case this week. If I just look at this week alone, here we go, let's go to June, and then just look at how this week has been playing out so far. Real estate still holding those gains, it's carrying that momentum. But now you notice that gold's kind of not really rising anymore. Commodities have had a little bit of bullishness, but pulling back, and then bonds are rallying now. So long-term bonds especially seem to be kind of, making a little bit of a breakout move, getting up above. A couple of days ago, we talked about it sitting at that 23% line and how we've been kind of hitting it multiple times. Well, we finally broke through it in the last 2 days, and we're breaking out inside of this longer-term Fibonacci retracement zone, with the bottom of it being here where we held support, and the top of it being up here, that 38% line way up here. So that one right there, 149. So that's, that kind of gives us an idea of how far, if we do continue this and maintain this bullish move with the intermediate line break getting above 80, this time with market sentiment line rising, potentially out of the bearish zone. Before we got that cluster, the market sentiment line was too low, so it was like struggling to really get going. This is a little bit different scenario here, so a much better kind of breakout environment. In fact, if you take a look at this chart here, the Keltner channels. Oops, sorry. I want to look at it with the Bollinger Bands. This one. We are breaking out of the Keltner channel and the Bollinger Bandwidth. So very, very strong move. Here's the Bollinger Bands here by themselves. Very strong move for long-term bonds. And look at what we have up above us. Absolutely nothing. No volume whatsoever, because we moved down so far so fast right there that there is absolutely no volume up above us, which again, that would be bullish for bonds. That's a vacuum that can get filled in. That doesn't mean it will, because nothing's ever 100%, but it's a vacuum that could be filled in, even just up to that volume node right there, 151, which is the top of this, the 62% level. You can kind of see this. There are two different ones. This is the longer term one, so let me make that a different color. So it stands out as more of a longer term move, and then this one here, which is more of the current intermediate run. So let me set it there, so you can kind of see, there's that top is the 62% of this current intermediate rally, or this intermediate pullback to the upside that we're on, and then the longer term is this orange one where we hit support and we're bouncing potentially up to the top of that Fibonacci retracement zone, the 38, if not higher, which is where I think it could ultimately get to, is up in here. The 78% line there, the 23%, this is kind of where I think the potential for bonds to make a run. Again, that would be most likely part of a broader risk aversion trade. That would not necessarily be the most bullish. You can also see the dollar would also be expected to take part of that, and you can see its unwillingness to get to really get above that 23% retracement level and get going. It's been sitting right around it, up and down, and then a long upper shadow now, with the intermediate line crossing below its market sentiment, and a bearish near-term high or two, suggests that there might be some downside for the euro-US dollar pair. So bullishness for the dollar would also be part of a broader risk appetite or risk aversion trade. So again, it supports this idea that the risk appetite trade has been very exhausted. Like it's tired. It's like me running a mile around the tracks. I mean, I'm on like at the last half of the last lap. I am just like sucking wind and about to die and keel over, but I'm still going, but I'm sucking wind. And so there's a lot of characteristics of that in the market here right now. It hasn't collapsed, and I don't think I would either. I think I might be able to make the mile, but it seems like we are getting signs that we're slow. My pace for that last half of the last lap is a lot different than my pace that I had in the first half of the first lap, right? It's, then I'm excited, I'm going, I'm getting going, I'm running really fast, and then by the last half of the last lap, I'm like, just make it to the end. Even if I have to walk, I'll make it to the end. And the market looks like it's to the stage where it's starting to walk the last, to the finish here, because it's just grinding. All right, now let's take a look at the sectors and how they're performing. And you notice, again, very, very inflation trade, right? With real estate doing so well and materials doing so well. And you can see energy off of that 422 low. And in fact, if I were to change this time frame to start on 423, so the next day after that low point, let's go to a daily chart again. Then you can see, in energy and financials with rising yields and materials and real estate. I mean, that's about as inflationary of a trade as you can get, and utilities not doing so good. Very, very, very inflationary. And you can also see technology and discretionary not doing very good either, both lagging behind the markets. So again, that's not the strongest, using that racing analogy. Like your strong runners right now are in a relay, for example, are technology and discretionary, and they're not doing so hot right now. These are good runners, but they're not the ones. And of course, these are the ones you really don't want to see leading the markets. But they're the ones that have the better market forecast pictures. Whereas, like, look at discretionary, we've got dark pink shading and a red line we have for a while. So it is actually in its own market pullback, its own intermediate pullback mode, XLY. I mean, that's dark pink shading and a red line. We're below 40. We have been. I mean, that's pullback mode. That's if the S&P looked like that, we would be, we'd say we're getting that exhale that we've been anticipating for so long. So it is in exhale mode, and some others are close. As you can see again, technology had been dark pink shading and a red line. We're above 60, but just barely, and we got a yellow line there. And you can see some of these others. You can see some of these cyclical areas like materials and industrials starting to lose some steam from an intermediate standpoint, as well as healthcare and even financials, close to getting below 80. So again, last half of the last leg, and you can see the rotation here. Give me 1 second. You can see the rotation. I mean, there's energy, there's real estate, materials is improving. Even if it's losing relative strength, it's got good momentum. That's the inflation trade. And you can see technology losing momentum, communication services losing momentum. XLY has been no momentum at all, gaining some relative strength, but no momentum at all. And utility staples, healthcare, down to the left. Remember, the longer term view of this is down to the left with all these cyclical areas and up to the right with these non-cyclical areas. So, whether or not, how many rotations we have left on it, but on the daily rotations, but the longer term rotations show again that, again, I don't know if we're on the last half of the last leg or last quarter of the last leg, but it does appear on that longer term rotation graph on how these sectors are rotating that we are indeed in the last lap of whatever race that we're running here, and it looks like we might have a leg or two left, but we are definitely kind of running towards the end of this particular race, this current intermediate run that's been very ongoing. Been going on since that low point there. I mean, it's a very long intermediate run. In fact, if you as I mentioned before on that longer term chart, all these intermediate pullbacks are marked by these red arrows on the 50-day moving average. So there's the one that we got in September. There's the two that we got last year. Obviously the COVID low point, and then the two in 2018, the one in the middle. I mean, these are all intermediate pullbacks that are marked by their red lines when we get below the 50-day moving average. And you can see we haven't had that since. We haven't had that. We've gone that long without one. So, kind of another sign of how extended this current run is, and how the sectors are kind of showing that, this is maybe the last lap of that intermediate run that we're on. Continuing with the theme of this idea of not being bearish, but not being bullish either, is looking at a trade here in EA. You can see it's been getting some red arrows. It's been kind of, the PPO has been grinding towards zero here. You can see it's got a little bit of a bullish market forecast chart, but very similar, like we're reaching a ceiling, and we're unable as of right now necessarily to peek through that ceiling. There's the top of the value area, the very strong support and volume node down below us. So again, so not bearish, but not really bullish breakout either. Among other things too, you can again take a look at some of these other indicators and see a lot of very neutral indicators. Just barely above 60, just barely above 100. Obviously not above that positive 200, which is kind of a breakout signal. The DMI, you can see here, up towards 30, but not above it. Below 20 on the negative, so bullish, but not breakout bullish. And then finally the three green arrows here. You can see again this idea of this getting a little bit of divergence, but already with the MACD histogram rolling over, starting to show signs of convergence, right? And the blue line hasn't turned over yet, but you can see we're not really pulling away anymore either. So that sets us up for a neutral trade here. So let's take a look at EA. There's a trade, as you can see, selling the 140, buying the 135, so right around that 20 delta. Selling the 155, buying the 160. That was a 20 delta when we got into it. This is what it looks like on. Let's see here. I need to get rid of that trade, and then this is the iron condor we had for June, and that we did in class. So let me get rid of that one. There we go. There's what our trade looks like. There's our break evens, and so our break evens are right here. So we've got room for it to move to the upside if it does break out, and kind of grind up there. There's a very strong support down below where we're at right now, where our break evens are even below that. So a lot of very strong, if we do pull back, very strong support that can hold us above that low point. So if it continues to grind like we did in June, going into June expiration, then we can profit into July expiration without having to worry about earnings yet, with this iron condor, basically letting both the bull put and the bear call up above it expire worthless is the goal of that particular trade. So that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on our website. You'll be able to interact with other viewers of the video. Let's keep this conversation going. So open up any threads with any questions or comments you have. Reply to other people's threads. We can be able to keep talking about what the market's doing here with what we've been covering in these videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Like us on Twitter and Facebook too. Comment on our videos down below. Follow us on Twitter, join our Facebook group. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.